you get a raise, a real one, like meaningful, not the 2% keeps up with inflation kind. You tell yourself this is the year the gap finally closes. 6 months later, you look at your account and the number is the same as it was. The raise happened, the raise went somewhere. You just cannot tell where it went. That pattern has a name. It is not a discipline problem and it is not a math problem. It is a structural problem, like specifically a cash flow problem. And until you understand it at the structural level, every raise, every bonus, and every windfall will keep disappearing into the same invisible drain. Here is the thing most financial content will not tell you directly. Having a high income and understanding cash flow are completely different skills. There are people earning $300,000 a year who are one bad month from a cash flow crisis. There are people earning $60,000 a year who have positioned themselves to stop working in their late 50s without needing a miracle. The difference between those two groups is not discipline, not luck, and not income level. It is whether they understand the structure of how money moves through their life. Most financial conversations start at the wrong end of the equation. They start with income, how to earn more, how to invest better, how to accelerate your savings rate. Those conversations are not wrong, but they are downstream of the one that actually matters. If the underlying structure of your cash flow is broken, more income flows into the same broken structure and produces the same result. It just happens faster. My name is Jack. I am 56 years old. I have spent years watching both groups up close. The ones who figured this out and the ones who earned more and more and never felt more secure. The difference is always the same. If this is a conversation you have been needing to have, hit subscribe. If this changes how you look at your own monthly numbers, that is what this channel is here for. Quick note. I'm not a financial advisor, and nothing here is financial advice. These are real frameworks, real math, and my own perspective from watching what actually builds security versus what just looks like it does. What you do with it is your call. Let's get into the structure. What cash flow actually is. Most people hear cash flow and think, is there money left at the end of the month? That is part of it, but it is the smallest part. Cash flow, properly understood, is the structure of how money enters and exits your financial life. What categories it flows from, what categories it flows to, and at what rate. It is not just a monthly balance, it is a diagram, and the diagram reveals things that a monthly balance will never show you. The Federal Reserve Survey of Consumer Finances, which tracks household balance sheets across the United States, consistently documents one of the most counterintuitive patterns in personal finance. High-income households frequently have lower net worth growth than mid-income households with lower lifestyle expenditures. The income came in, the income went out. The structure was never built to redirect any of it toward wealth-generating positions. This is not an edge case. It is the norm for most professional class households. What actually matters in cash flow is not the number. It is the direction. Money flowing toward you from assets you own, that is productive cash flow. Money flowing away from you permanently through obligations and consumption, that is destructive cash flow. Net worth tells you the score. Cash flow tells you which direction the game is moving. The confusion between these two concepts is the most expensive financial mistake most people make. You can have a rising net worth and a worsening cash flow position at the same time. Your home appreciates by $50,000 in a year. Your net worth statement looks great. But if your monthly cash position, what actually arrives in your checking account and stays there, is shrinking because of increased debt obligations and lifestyle costs, the net worth number is a misleading headline. The underlying story is going the wrong direction. The 3 cash flow problems. There are 3 structural cash flow problems that trap most people, and they compound each other. The first is single source income concentration. Almost every working person's primary income comes from one source, a job. That single flow works fine until it stops. Layoff, illness, industry shift, and then it stops completely. Not reduced. Zero. A person with one income stream and no assets generating passive flow has a brittle financial structure, regardless of how much that one stream pays. Thomas Stanley and William Danko documented this pattern extensively in The Millionaire Next Door, the 1996 study of actual millionaires in the United States. The households that maintained lasting wealth were not the high earners with single income streams. They were the households that had deliberately constructed multiple lower stakes income flows over time. The second problem is lifestyle inflation consuming every income increase. The mechanism is simple and almost universal. You earn more, your spending adjusts upward to match, and your net monthly cash flow, the gap between what comes in and what goes out, stays exactly the same or shrinks. The raise felt like progress. The math says it produced none. A person earning $50,000 and spending $35,000 has $15,000 in annual positive cash flow. A person earning $130,000 and spending $125,000 has $5,000. 3 times the income, 1/3 the actual positive flow. The higher earner looks more successful in every social context. The first person is building wealth 3 times faster. The third problem is what I call asset illiquid, cash poor. You have significant net worth, equity in a home of 401k with a good balance, but that wealth is sitting in containers that produce 0 monthly cash flow. Your home equity does not send you money every month. Your 401k balance does not generate income until you withdraw it decades from now. You look at the numbers and think you are on track. But your actual monthly cash position, the money available to you this month, has not improved. The net worth number went up. The structure did not. The income type problem, here is something the salary conversation almost never includes. Not all income is structurally equal. The IRS recognizes 3 distinct categories of income, and they are meaningfully different in both tax treatment and structural behavior. Earned income, W-2 wages, salary, self-employment income, is taxed at the highest marginal rates, requires your active ongoing labor to exist, and stops completely the day you stop working. Portfolio income, in dividends, capital gains, interest, is taxed at lower preferential rates and requires capital to generate it rather than time. Passive income, rental income, royalties, certain business income where you do not materially participate, carries favorable tax treatment and critically can continue flowing whether or not you show up to work that day. Someone with a $200,000 salary and no assets has one stream of earned income that disappears the moment their employer decides to let them go. Someone with a $100,000 salary, a rental property generating $18,000 a year, and a dividend portfolio paying $8,000 annually has 3 streams totaling $126,000, 30% less in salary income, but structurally far more resilient. The diversification conversation in most financial content is about investment allocation. Stocks versus bonds, domestic versus international. That conversation matters, but the deeper diversification is at the income type level. How many different mechanisms are producing cash flow in your direction, and how many of those mechanisms can survive a bad year in your primary career? A portfolio of only earned income is the most fragile financial structure that exists. It requires your continued active participation every single day. It concentrates all risk into one relationship, you and one employer or you and one set of clients. The people who achieve genuine long-term financial security almost always shift their income mix over time, less earned, more portfolio, more passive. The shift does not have to be dramatic or rapid. A dividend portfolio that generates $400 a month is small in dollar terms and enormous in structural terms. It represents a second mechanism, a second direction, a second answer to the question, where does the money come from if that one job disappears? The debt and flow problem. Consumer debt is not just a balance problem. It is a cash flow problem. And it is often the more damaging of the two. Every month that you carry a debt obligation, money flows away from you before you have any opportunity to redirect it. A $500 monthly car payment on a vehicle worth less than the loan, a $400 minimum payment on revolving credit card balances. combined. $900 per month, $10,800 per year, permanently flowing out before you make a single wealth building decision. Over 10 years, that $900 per month represents $108,000 in cash flow that left your life. If that same $900 per month had been directed into index funds generating a 7% average annual return, it would be worth approximately $155,000 at the end of that period. The difference between those two outcomes is not income, it is the structure of where your cash flow is directed. This is why debt elimination is not just a financial strategy, it is a cash flow liberation strategy. Every debt obligation you eliminate is not just a balance you erased, it is a monthly cash flow you freed and redirected. The balance sheet improves, the flow improves, both compound, and the compound effect works in both directions. Carrying high-interest consumer debt while simultaneously trying to build investment wealth is fighting yourself. The debt drains at 8 to 24% annually. Your investments grow at 7 to 9%. The math is working against you at the structural level until the debt is gone. This is not a moral argument about debt. It is an arithmetic argument about which direction your cash flow is moving. The asset side of the equation. There's a number that most people never calculate about their investments, the cash yield. Not the total return, not the price appreciation, the actual cash that flows to you per month from assets you own. A $500,000 home generates zero monthly cash if you live in it. The appreciation is real and the equity is real, but no cash arrives in your account on the first of the month from that asset. A $500,000 index fund portfolio invested in dividend-paying funds at a 2% yield generates $10,000 per year, $833 arriving in your account every month without you doing anything. A $500,000 paid-off rental property with a $1,200 monthly net profit after all expenses generates $14,400 per year, money that arrives whether you work that day or not. Same net worth, 3 completely different cash flow structures, 3 completely different pictures of actual financial security. The person with $500,000 in home equity looks the same on a net worth statement as the person with $500,000 in cash producing assets. They are not the same. They never were. The net worth calculation obscured the only number that actually matters when you stop working. What flows to you each month without your active labor. The identity shift. Before you understand cash flow, wealth feels like an accumulation problem. You need to save more, earn more, invest more. The amount is the thing. More is always the answer. After you understand cash flow, wealth becomes a structural problem. The question is not how much is coming in. It is how the money that comes in is flowing. Is it flowing toward you from assets you control, or is it flowing through you and out to obligations and consumption before you ever make a conscious choice about where it goes? The people who are genuinely financially secure, not just high net worth on paper, but actually able to stop working on their own timeline, almost universally have one thing in common. They understand the flow. They can tell you in specific numbers how much cash comes to them from each source every month and how much leaves through each obligation. They have a cash flow statement, not just a budget. The budget tells you what you planned. The cash flow statement tells you what actually happened. 3 steps to take right now. Step 1, build your actual cash flow statement. Not a budget, a cash flow statement. A budget is forward-looking. A cash flow statement is backward-looking and descriptive. Pull the last 3 months of statements and map every dollar that moved, where it came from and where it went. Categorize all inflows by source: salary, rental, dividends, side income, and all outflows by type: housing, food, transport, debt obligations, discretionary. The first time you do this, you will find flows you did not know existed. That is the point. Step 2. Identify your largest destructive cash flow, the single monthly obligation that drains the most cash before you make any choice about where it goes. For most people, this is debt, a car payment, a credit line, a student loan. Calculate the total cash flow that obligation will drain over the next 3 years at current minimum payments. That number is often stunning. Then identify the specific action that would eliminate it fastest and calculate what that monthly cash flow looks like, freed and redirected toward an income producing asset. Step 3. Set a productive cash flow target, a specific monthly number that you want flowing to you from sources other than your primary job, not a net worth target, a flow target. Start with something modest, $200 per month in dividend income or $200 per month in rental income after all expenses. The exact number is almost irrelevant at first. What matters is building the habit of thinking in flows rather than balances and making at least one structural move per year that increases your productive inflow. Wealth is not a balance, it is a structure, and the structure is always made of flows. The person who understands that principle is playing a fundamentally different game than the person who does not, regardless of how much either of them earns. Drop in the comments how many income sources are actively flowing to you right now outside your primary job. I will read everything.